You have eaten this, every single one of them. Pringles, Cheez-It, Pop-Tarts, M&M, Snickers, Twix, Skittles. What if I told you all these snacks now belongs to one single company, one family business, and $36 billion to make it happen? On December 11, 2025, Mars, the company behind M&M and Snickers, completed the biggest food industry acquisition in a decade, buying Kellanova, the company behind Pringles and Cheez-It, for $36 billion. In the next 15 minutes, I'm going to tell you exactly how this deal happened, why it took 16 months from the announcement to completion, why one company paid 36 billion for another, and what every business person should learn from it. No jargon, just a great story about snacks, strategy, and a whole lot of money. Let's understand about the buyer Mars. Mars is one of the most fascinating companies in the world because most people do not even know how big it is. Mars is an American company headquartered in McLean, Virginia. It was founded in 1911 or 114 years ago by a man named Franklin Mars, who started making candy in his kitchen. Today, that family business is having total annual sales of $54.6 billion. Here is the most remarkable part. Mars is entirely privately owned by Mars family itself. It has never listed on a stock exchange, no IPO, no public shareholders. The same family that started making candy in 1911 still owns 100% of the business today. Mars operates three main businesses. One is confectionery, the sweets and chocolates. The most brands you know: Mars, M&M, Snickers, Twist, Milky Way, Skittles, Starburst, etc. Two is pet care brands like Pedigree, Whiskas, Royal Canin. And three is food brands like Ben's Original Rice and all. In 2023, their snacking division alone was generating 18 billion in revenue. That is, the sweet snacking division alone is generating 18 billion in revenue. But Mars had a very specific problem, a gap in their portfolio. They were king of sweet snacks, but they were almost completely absent from the world of savory snacks like crisps, uh, what we call Pringles. Like savory snacks, they are completely absent. You understood, right? What is the reason of this acquisition? Let's understand about the seller now. Seller is Kellanova. This is a company most people have never heard of by that name, but they definitely have eaten their products. Kellanova was actually the old Kellogg's company rebranded in 2023 after splitting into two separate businesses. The original Kellogg's breakfast cereals business went one way. The everything else, all snacks and international brands, became Kellanova. So Kellanova was headquartered in Chicago. It was listed on the New York Stock Exchange, and their annual revenue was almost $13 billion. Their brand portfolio is extraordinary, like Pringles, the world's most recognized crisp in a tube, Cheez-It, American most loved cheese cracker, Pop-Tarts, the iconic breakfast pastry, RX Bar, a premium protein bar brand, Eggo Waffles. So plus Kellogg's have this international presence in international markets like India, Australia, UK, and many other countries. Eat already. Mars had all the sweet snacks. Kellanova has all the savory snacks. These two companies were not competitors; they were complements. Combining them created one complete snacking empire. Let's talk about the strategy behind $36 billion decision. Mars' reason is clearly the savior gap. The savory gap. Let me put Mars problem in simple terms. The global snacks food industry is worth more than 600 billion a year and growing. People are snacking more than ever. Smaller meals, more grab and go eating, more impulse purchases. This is one of the most attractive consumer business in the world. Mars was already dominant in sweet snacking, but when you walk into a supermarket and look at the snack aisle, sweet is only half the shelf. The other half, crisps, crackers, pretzels, savory snacks. Mars had almost nothing in that. So imagine you own the most successful North Indian restaurant in the city. You're number one, but you have no South Indian dishes at all. A competitor who makes incredible South Indian foods is available to buy. Do you build a South Indian kitchen from scratch, which takes 10 years, or do you buy the best one that already exists? Just an analogy. So Mars choose to buy, and their stated goal is very specific. They want to take the combined snacking business from 18 billion in annual sales to revenue of $36 billion. So doubling their snacks division within the next decade. With Kellanova, they now have the brands and the distribution to try. There is another reason behind why Mars acquired Kellanova, which is competition. The two biggest rivals they face in the snacking are PepsiCo and Mondelez International. PepsiCo, which owns Lay's, Doritos, Quaker, and Tropicana. Mondelez International, which owns Oreo, Cadbury, Ritz. Both of these companies are already in both sweet and savory snacks. Mars was fighting them with one hand tied behind its back, and Kellanova changes that. From Kellanova's perspective, why agree to sell? Kellanova was only created in 2023, just 1 year before this deal. The company was freshly separated from Kellogg's cereals and was operating as an independent business for the very first time. Running a standalone snack company at scale is extremely competitive. You need enormous investment in marketing to defend brands like Pringles and Cheez-It against private label competitors. You need massive distribution, and as a publicly listed company, you are under constant pressure from shareholders for the quarterly results. When Mars came with $83.5 per share in cash, which was premium of approximately 33% over where Kellanova stock was trading at the time, the board unanimously said yes. Every single director approved it. Kellanova stock before the deal was trading around 62 to 65 per share, and Mars offered 83.5 per share in cash, which is 33% above the actual trading price, and every director approved it. And the shareholders will get direct cash without any shares or something like that. This is a very brilliant deal for the shareholders. Let's break down the deal numbers. Let's talk about the money. 36 billion. This is the headline number. But what does that actually mean, and how did Mars pay for it? How did the deal was structured? First, this was an all cash deal. Every Kellanova shareholder received $83.5 in cash for every share they owned. No Mars stock, no installment. Direct cash into their accounts on December 11, 2025. Now, here is a genuinely interesting question. How does even a 55 billion company pay 36 billion in cash? Mars is privately owned. They cannot issue new shares to raise money the way public company can. So the answer is debt. Mars raised 26 billion in bonds, essentially borrowing money from bond markets and used that plus their own cash reserves to fund the deal. They secured a 29 billion bridge loan facility to guarantee the finance before the deal was even announced. This is standard for large acquisitions. You line up the money first and then announce. Value a 13 billion revenue company at 36 billion. This is where valuation becomes interesting. Kellanova was not a startup with no revenue. They had already 13 billion in real actual proven annual revenue. So this valuation is grounded in real numbers. Mars paid roughly 2.7 times Kellanova's annual revenue. In business, we call this a revenue multiple. For a premium consumer business with highly margins and iconic brands, it is actually a reasonable price. Not cheap, but not crazy. Think of this way: if you owned a shop that made 1 million a year in revenue and someone offered you 3 million, would you think seriously about it? The buyer is essentially saying, I can run this better, grow it, and earn back my investment over time. Mars logic is simple. Kellanova's brands are global. Pringles alone is sold in over 140 plus countries. When Mars can put its global distribution behind Pringles and Cheez-It, those brands can grow significantly. The 36 billion is what it costs to get the ownership of that future growth. Here is the most educational part of the deal, the timeline. The deal took 16 months. Why? The answer is regulators. When two enormous food companies merge, the government around the world need to check that the combination doesn't reduce the competition and lead to higher prices for consumers. Mars and Kellanova needed approval from 28 different regulatory authorities across the world. 28. Every major country where the brands are sold had to independently investigate and approve the deal. August 14, 2024 was when the deal is announced between Mars and Kellanova. November 1st, 2024, Kellanova shareholders approved the deal, and June 2025, US Federal Trade Commission clears the deal, stating that no competition concerns in America. And summer 2025, European Union opens a formal antitrust investigation. This is the biggest hurdle of the deal. In December 8, 2025, EU gives unconditional approval for the deal. No competition issues at all. December 11, 2025, deal closes, and the Kellanova got delisted from New York Stock Exchange. 5 lessons to learn in this deal. Lesson 1. Buy what it takes too long to build. Mars could have tried to build their own crisp and crackers brand from zero, but building Pringles from scratch would take 20 to 30 years and billions of dollars marketing spend with no guarantee of product success. Buying Kellanova gave Mars those brands instantly with 140 countries of distribution already in place. In M&A, you pay premium to skip the queue. Lesson 2: complementary beats competing. The best equations are not about buying a competitor, but they are buying a complement. Mars in sweet snacks plus Kellanova in snacks creates something neither had before. Complete snacking portfolio. When two businesses fit together like puzzle pieces, the combined businesses create more value than either alone. Lesson 3: scale creates negotiation power. Kellanova on its own had to fight for the shelf space in supermarkets, negotiate with the distributors, and outspend PepsiCo and Mondelez international marketing. With Mars behind it, Pringles now had the resources of 55 billion business. Scale giving you pricing power, distribution access, the ability to invest in brands that smaller companies cannot afford. These why large companies keep getting larger. Lesson 4: regulatory compliance is a deal risk you must price in. Mars and Kellanova expected the deal to close in first half of 2025, but it closed in December 2025. 6 months late because of EU investigation. Every large deal carries regulatory risk. Companies that do not plan for this end up with expensive bridge loans sitting idle, integration plans on hold, and restless investors. Smart Asian makers build regulatory strategy before they have even announced the deal. Lesson 5: premium brand business are worth more than the real numbers show. Kellanova had 13 billion in revenue, Mars paid 36 billion, nearly 3 times. Why? Because Pringles and Cheez-Its are not just products, they are behavioral habits. Millions of people automatically reach for Pringles when they want crisps. This automatic trust and loyalty is worth far more than 1 year's sales. When you truly build an iconic brand, you buy decades of consumer memory, and that no spreadsheet can fully capture. These are the 5 lessons we learned in this deal. Hope you liked the video. If you want me to do more deals like this, please comment on which industry you want me to do the more deals.